to Indianomics. Welcome as well to our guests, the State Bank of India Managing Director, Mr. Krishna Kumar, Citibank's Managing Director, Soumyo Dutta, Goldman Sachs Managing Director and Economist, Tushar Poddar, and ICRIER's consulting economist, Renu Kohli. Let's get cracking straight away. And Tushar, the first question to you, because you, if I remember reading from all the reports, have been hooting for a rate cut and for several more to follow. What is the compelling case?
I think there are several. Core inflation should be key to a monetary policy decision, and core inflation is coming off sequentially as well as year on year. We're expecting it to be about 5% for the month of March.
Okay.
So that takes away any reason for the central bank not to cut rates, especially when rates are so high that it is really biting the economy. You cannot have GDP growth at 6%, inflation, core inflation at 5%, and rates at 8.5%. So the RBI needs to cut and needs to continue to cut for a while.
Okay, well, understated inflation. I mean, we know that inflation and core inflation will be at 5%, but there is a huge understated inflation, Tushar. Some of it hopefully will get passed on. So would you say there is much of a headroom? I take your case that there would be some case, but even the forward-looking inflation numbers, what are your forward-looking inflation numbers, and therefore how much headroom?
I think you have to make a distinction between headline and core. I think headline, there is still some concerns about suppressed inflation in energy prices and food prices and fertilizer prices. But I don't think that there is too much suppressed inflation in core, especially if you look at demand side pressures, which are really non-existent at this stage. Even taking the worst case potential growth number for GDP at 7%, we're growing somewhere around 6% right now. So there is a negative output gap. So I don't think that there is much scope for core inflation to rise up from here. So I see the suppressed inflation as a headline problem, not as a core problem.
Okay. Well, Renu, let me get you in. You weren't so confident that the Reserve Bank has so much of a headroom. At least two compelling reasons against the rate cut would be that current account deficit is becoming a huge problem. Savings have been falling. Do you think there is a case right now to cut, and how much of a headroom?
There is a case for cutting. It's as far as you can make out from the growth side. Definitely demand pressures have eased, which were responsible for inflation. But at the same time, I think the key risks that the Reserve Bank had flagged in the past recent reviews of monetary stance were crude oil prices, fiscal position, and suppressed inflation. Of the three of these, crude oil prices still remain elevated, and suppressed inflation is yet to pass through because administered prices have not been revised. And what is only clear is the fiscal indicators. Monetary policy also needs to move ahead of economic activity, and looking ahead, I think notwithstanding the fact that the past recent momentum indicators of core inflation have been coming down consistently for the past 3 months, but at the same time CPI, which is a new series, which is broader based and a better indicator, though untested at present, it still moved up from 7.7 to 8.8% in February. And going ahead, I think all these risks remain. So there is certainly, I would say that there is not much of an argument for a rate cut on the basis of inflation. But yes, if the Reserve Bank does want to look at growth a little bit more, perhaps there is a sense there are equally strong arguments from the growth angle.
So you would say one cut, or you would say very little by way of cuts? How many do you think the Reserve Bank can do? 25, 50?
I think it should be more of a symbolic rate cut of about 25 BPS. I think there are two other asymmetries which have moved ahead or onto the center stage on the RBI's policy reaction function. So it's wider, as it were. It's not just growth and inflation. There is this enormous current account deficit, and if the RBI shifts its weight or stance in favor a little bit towards growth, then one of the pressures on the current account will increase, because whenever India grows, okay, not at the growth
fair point. Renu, let me get the man who is incessantly looking at the forex markets day in and day out, every second. Soumyo, do you think that this is going to become a very huge problem? The current account deficit, 4%, psychologically big. Do you think the Reserve Bank will have to worry terribly about that and ensure that the rupee forwards remain forbiddingly expensive, so that imports don't look very easy? I mean, if it's just going to take me 1 rupee or 1.5 rupees to hedge my imports down the line, I would perhaps go trigger happy on imports, something the Reserve Bank will not or ought not to want.
I agree. Current account deficit is definitely a problem, and it's clearly one of the new variables on RBI's radar, and they should be worried about it. At 4% or even $70 billion, it's definitely not looking pretty. But how much of it can be engineered by means of forward premium or forward points, I have my doubts on that. Clearly, forward points, again, we have seen it's typically an interplay between funding curve and a currency play. At times currency play rules, at times funding play rules. As you mentioned, if it is suddenly 1 rupee and importers find it very cheap to cover their imports, yes, there would be a huge amount of cheapening of imports, which clearly is not in RBI's radar, and they won't want it that way. But guess what, it can't come to that kind of level, because much before that there will be a lot of other players who would be wanting to pay that kind of forward points, so the premium, and lock into a funding curve, because then funding becomes cheaper. So the NR flows, the ECB flows, all the foreign currency borrowing flows converted into dollars, converted into local currency, that suddenly becomes cheaper. So there is an automatic balancing going on that way.
Okay. So your own sense is that the RBI has a headroom to cut, and cut much more than just 25?
See, what worries me clearly are quite a few factors. For example, a negative fixed capital formation for 2 quarters. If you see, those numbers are worse than the height of crisis that we had in 2008, right? So these things typically should not happen in a growth cycle. So that worries me. The other thing which is clearly of concern to me is GDP now at 6.9, then trending to 6.1. What does it take to a 5 handle, if the current tightness remains? Liquidity tightness is clearly a problem, and which sector is definitely feeling the heat is manufacturing. So new capacity creation, supply side bottlenecks, all the things that you have been talking about, they are really not being helped greatly by this kind of tight liquidity and high rate environment.
That point is taken, that there is a negative gross fixed capital formation for the first time in many years, a number we have seen. But Mr. Krishna Kumar, since you speak to people who are interested in capex all the time, really how important is interest rates for capital expansion? Interest rate would be very important for perhaps people who are looking at EMIs, looking at paying EMIs and booking into a house. But capex, I mean, how important is the interest cost for capital expansion? Is it that is stopping capital expansion, interest cost?
No, I believe that certainly people who are putting up projects and setting up, say, fresh manufacturing facilities do look at interest cost as one of the major factors. But then the reason for capex not taking place is probably not that interest costs are high, but more the feeling that there is no potential, or there will be no potential demand for the product which is being set up, the product which is going to be manufactured. So I think that is more of an issue rather than the interest cost.
So then again, growth becomes important, as Soumyo has been arguing. Okay, but Mr. Krishna Kumar, the other big reason which might, worry the Reserve Bank, maybe not just yet, but clearly an important worry, is the falling savings rate. Now, for 2 years or a little more, we have had a negative real interest rate, and that clearly is already beginning to impact savers. Maybe not the only reason, but that's clearly one big reason why savings rate is going down. What's your sense? Do you think even if a rate cut happens, you will have the luxury of cutting down deposit rates much? As it is, 13.5 last count. I've never seen deposit rates at that low a cut in a long time.
No, that is true. What you're saying is absolutely right. There is a big dilemma right now. Even if the Reserve Bank does cut the policy rates next week, the repricing of the liabilities might take time, in the sense of it might take a couple of weeks or a month. But probably if there is a rate cut of a fairly reasonable magnitude, let's say 25 basis points on the repo side and maybe yet another 25 basis points on the CRR side, there could be some readjustment of the rates at the longer tenure in terms of deposits. But I don't see any major change in the short end deposit rates.
So what do you think will be the upshot, assuming there is a rate cut, and at the moment our poll is only saying 45% are expecting a CRR cut. So assuming a rate cut, what do you think you will be able to move on? You will be able to cut deposit rates and lending rates in the same proportion?
No, I think the industry would certainly look at cutting interest rates for the industrial segment. Maybe not immediately the day the rate cuts, or in the same week the rate cuts are announced. There might be a time lag. I would say a time lag of about a couple of weeks or a month before the rate cuts take place. And the first part of your question was, yes, I do not believe that it would be the cuts in the deposit rates, if they happen, and the cuts in the lending rates, if they happen, would not be in the same proportion, because the banks would also like to maintain to some extent their net interest margins.
So you would expect more deposit cuts and less of lending rate? I thought people would cut more of lending rates because you want money to move.
That's true, but then it depends on sectors whether it will not be an across the board reduction of
straight away my question is, my question is, will there be more of lending rate cuts or more of deposit cuts?
My sense is there would be a little more of deposit rate cuts.
Okay.
That's my immediate reaction to that.
All right, fair enough. Tushar, now that brings us to the two problems that the Reserve Bank is likely to face. It's a very strong, effective argument you're making in terms of, growth now becoming slow enough for the Reserve Bank to get a feeling that core inflation cannot rise too much from here on. That point is taken. But current account deficit, and let's first tackle the savings rate question. Can the Reserve Bank afford to ignore, in a more secular sense, it is the savings rate and the investment rate that has given us this secular 8% growth? Does it have much headroom on the savings rate front?
So let's first dispel the notion that a rate cut is going to worsen the current account deficit. I don't think so. The current account deficit is nothing but the savings investment balance. S minus I is equal to the current account deficit. So what you want to do is boost private savings as well as public savings. Now, on the public savings side, we've seen the problem with the fiscal deficit. The direction, though, is in the right way.
Okay.
The trajectory. We don't want too much of a fiscal cut at this stage, because that's going to act as a drag on growth. So we've got to do it in a calibrated approach, in a medium-term sustainability framework. On the private side, what you need is to see growth coming back. That influences depositor behavior, and you want to see inflation coming down. As long as people's expectations about inflation come down, private savings will pick up. And let me remind you that private savings has not really fallen that much. It's really public savings which is causing the rise in the current account deficit.
Household savings in the financial sector has fallen so sharply.
Well, it's because of a move away from financial savings to physical savings,
okay,
which is a different issue. Rather than, we do have this demographic tailwind behind us in terms of the savings rate. So I think that if you can start the growth process again, the savings will follow, as it normally does. It is highly pro-cyclical. So I don't think we should confuse the current account deficit with rate cuts, because the rate cuts will do nothing to worsen the current account deficit. In fact, it may actually help ameliorate it.
Okay, but that's, I can tell you, a lot of central banking thinking does worry that any cut in interest rates would increase consumption, and that would include imports, consumption in every kind. But we have to come to the bond markets, Soumyo. How do you think bonds are going to respond if there is a rate cut? At least for the next 4 to 6 weeks, what kind of a range do you see? There is one guess out there in the market which believes that bonds would go to 8% by September 30th. Where do you stand?
I think for the next 4 to 6 weeks, horizon 8.25 can be a floor. 8% yes, provided RBI surprises us by 50 basis points rate cut. Otherwise, I think 8.25 and 8.75, I would put that as a range for the time being. And clearly, what is also an important factor in that market right now is RBI's open market operations, and how much they come in the secondary market and how much they buy in the secondary market. That's clearly going to determine the price action. But I think with the 25 basis points cut, I wouldn't be very ambitious, and for example, if you see from 880 after the devolved auction of the first auction in the calendar fiscal year, we are already down to 845 kind of level. So 35 basis points, it has pretty much come off in anticipation of this. So it's pretty much priced in there.
Okay, so you would put the range from 8.25 to 8.35? Sorry, 8.25 to?
8 3/4, so 8.75.
Okay. All right. Mr. Krishna Kumar, just one final word from you on growth. What are you penciling in by way of credit offtake and deposit growth at all this year?
Well, for the year 12-13, we are looking at a deposit growth of anywhere between 25 to 30%. I know that's very optimistic, but we think that we can pull it off.
Okay.
And as far as the credit offtake goes, I would say in the range of 20 to 25%, but we're yet to yet to finalize the numbers, but it's going to be in that range.
Well, I think this still sounds very, very ambitious in terms of expectations of deposit and a credit growth. One point is very clear. All our guests here are expecting that rate cut on Tuesday itself. The debate really is on what the Reserve Bank can do thereafter. So at least good news perhaps for those of you who are looking to book loans on Tuesday. That's it on this edition of Indianomics, but a lot of issues remain on what the Reserve Bank will say in that policy and what it will indicate in terms of its action hereafter. So lots to watch out for in future editions.